Time is an investor's closest friend. With good resources and appropriate skills, the more time you have, logically, the more you are going to earn. Therefore, investment is a decent option to build a nest egg for the future. For young investors, this is not only a good way to accumulate their wealth in the future, but young investors can also supplement their income, save for a house, and/or save for college. Therefore, there are several key steps to be taken into account when investing. Here are 7 tips for young investors saving for the future. 1. Begin your investing activities as early as possible. The earlier you start investing in your life, the less financial burdens you will have in the future. For example, spouse and kids expenses, mortgages, etc. will come at a later point in your life in your late 20s or 30s. 2. Learn and educate yourself with the entire process. It's essential to be familiar with the market, and understand the business you're investing in. The example given in the beginning, $1.42 million may look a huge sum, but its future value may be equivalent to that of $40,000 of today. Therefore, for a couple that wants to use that money after their retirement for another 20 years or so will not benefit much. Therefore, it is essential that you know the process, the costs involved in the stocks and equity options. 3. Choosing between stocks and bonds. Young investors find it difficult to choose between bonds and stocks. Stocks are riskier but have a higher return than bonds in the long term. 4. Learn to save rather than spend. To be an investor, you need money. To have the money, you need to save rather than spend. This advice is the most obvious one given out by top business professionals. Hence, without ado, to be a successful investor, you must do something that nobody in the world wants you to do. Save some of your money instead of spending it. 5. Diversify your portfolio. Diversifying your portfolio means you must at all time maintain a portfolio that is composed of all kinds of assets, from high risk to medium risk to low risk. The medium and low risk asset compensates the high risk one, and the aggregate returns are generally higher than a single asset portfolio. The wise decision to make is to reinvest your returns to earn greater returns, rather than spend those returns. 6. Manage your savings and your debts. Some people make a bad habit of spending money based on future expected inflows. This is clearly a mistake, relying on a raise in income that has not yet been confirmed. Therefore, always choose to spend your money based on your actual and current financial state, as this can prevent some serious credit crunch issues in the future and spare extra money for investments. 7. Get to know the taxes and inflation. Mostly investors forget how much inflation and taxation can affect their returns. Inflation will impact your real returns. If inflation is high, real returns will be low. The future inflation rate will also impact your future earnings. There are asset options that either have a tax liability or are a tax-deferred account. Make sure you know your tax policy and that a tax-deferred account will build wealth faster than a tax liability account.